Hey guys, it's Michael. In today's video, I'm going to go over 8 key factors that everyone should be aware of that will affect whether or not we see the economy recover and people get their jobs back, or if we will see another market crash and the economy will go into a recession. Right now, there are over 40 million people who are unemployed, and when the unemployment report comes out for May, it is expected that the unemployment rate will be 20 to 25%. And these are rates that have only been seen during the Great Depression. On top of this, the stock market has been on a roller coaster since mid-February. We had the fastest ever 35% collapse from all-time highs earlier in February, followed by one of the strongest rebounds in U.S. history. And right now, we've recovered 70% from where we were at all-time highs earlier in the year. So whether you're recently unemployed, you're retired, or you are still employed, this video is for you because these 8 reasons will dramatically affect how everyone makes money moving forward and whether or not we will see the market crash again. So let's jump right into it and let's get into the first reason of the day, which is that the second wave of illnesses could dramatically affect whether or not we see the economy recover or not. Regardless of your opinion on vaccines, the bottom line is until we have a vaccine that everyone is willing to take and feels comfortable taking, there is a risk for a second wave of cases. Because until everyone has this vaccine and cannot transmit the disease, well then we are still at risk for more people getting the virus. And if this happens and we see another wave of the virus and it's worse than the first time around, well then we're gonna have to shut down the economy for a second time. With the United States starting to reopen right now, another shutdown would have severe negative impacts on the economy. We already see 40 million people unemployed, and another shutdown because of a second wave of the illness would be really bad for the economy. Moving on is with stimulus packages. Stimulus packages are only temporary. All of the packages they've proposed so far are only one-time payments. The CARES Act gave us a one-time $1,200 payment, and then the package that they're talking about for a second stimulus package is only another $1,200 payment. So because of this, stimulus packages are only temporary. Even if they decide to do monthly payments, they only last for so long. And what this means is that eventually businesses are going to have to pay their bills. The money will only last so long for people to pay their rent, pay for food. And with this being temporary, when money starts to run out, businesses and individuals are going to start spending less money and start being much more careful with how they spend their money. People are only going to pay for the necessities, and that's going to cause businesses to struggle even more, and that's going to cause the economy to have a longer recovery. Now on to number 3, and that is that the dramatic unemployment we're seeing right now will last much longer than the virus itself. Because we can't just expect the economy to open back up and businesses to be running at full capacity the second they open up. States have already started to reopen, and as you can see, businesses aren't doing the same as they were before the virus started. Currently, businesses are still struggling because people aren't as likely to go outside, go eat at restaurants, and spend as much money as they used to for 2 reasons. One is because of safety and social distancing, and the second is because people aren't making money right now, so they can't go out and spend more money if they're not making the money. So because of those 2 reasons, businesses are not going to be generating as much revenue, which means they can't have as many employees. If they're not making as much money as they used to, they can't pay more employees and they don't need more employees. So until we see businesses start running at full capacity and starting to grow again, we're not going to see the unemployment rate go down significantly because they're not going to be able to rehire their employees. Number 4 is that irreversible damage to small businesses. Currently, there's a lot of businesses that have had to file for bankruptcy or have had to shut down completely because of the virus and because of the lack of revenue that they are generating. Many businesses have received funding through either the EIDL program, which is the cash grants, or they received PPP loans from the government. However, these loans and this money has a lot of restrictions on how it can be used. For example, with the PPP loan, it's only forgivable if businesses use 75% towards payroll expenses and then 25% to other expenses. So this makes it very difficult for businesses to survive and stay in business. And on top of this, this money only lasts for so long. Because the virus and everything has gone on for months now, and businesses are still going to be struggling, it is forcing a lot of companies to have to shut down. For example, companies like Brio Restaurant, Religion Apparel, and J.Crew have all filed for bankruptcy during the virus. Since the start of the virus, there have been a number of public companies that have had to file for bankruptcy. So it'll be interesting to see what goes on here, but it's important to keep in mind that no matter how much help these small businesses receive from the government, it still might be too little for them to actually stay in business. And this is going to cause a lot of closures and cause a lot of businesses to have to shut down even more than what we have already seen. Next up is number 5, which is that mortgage defaults. Under the CARES Act, borrowers have been able to file for mortgage forbearance, which allowed them to postpone their mortgage payments for 180 days initially, and if they wanted to apply again, they could get another 180 days. So this is a total of 1 year total that you can apply for mortgage forbearance. However, the longer this crisis goes on and the longer people are without jobs, the more likely it is that we're going to start seeing mortgage defaults, and then we could see a real estate crisis like we saw years ago. Next up is number 6, which is that we've been seeing a reduction in the amount of stock buybacks. So what stock buybacks are when companies buy back their own stocks, their own shares of their company from the stock exchange. Essentially what this does is that it reduces the number of outstanding shares in the market, and it drives the price of their company's stock up because there are less shares available. When companies are doing well and they have extra cash, they're able to buy back shares of their company, which helps to drive the stock prices up. Right now, because a lot of companies are not generating enough revenue, not making enough of a profit, they're not able to do this as well, which will cause stocks to not go up as much as they previously would have if companies could buy back shares. Next up is number 7, which is a looming recession. This is what we've been talking about the entire video. But in terms of how this crisis has affected the global economy, economies all across the globe have been starting to have recessions. They've had to implement stimulus pack on top of stimulus package on top of stimulus package. We've seen in Europe that they had to pass another round of stimulus packages. In Japan they had to, and now the US, we're talking about a second stimulus package as well. And just because all of the global economies are spending more money with stimulus packages to help with the economy, if we're spending more and more money, it can lead to serious inflation. For example, in the US, we've spent trillions of dollars this year. The more money we keep printing out, that could lead to inflation and cause the value of the US dollar to significantly drop. And lastly is number 8, which is consumer sentiment. And essentially what this is how you feel about the market. What do you think is going on? Because one of the biggest driving factors of how the market will do is based off of fear and greed. If people think there's a lot of fear and uncertainty in the market, well, then they're not going to spend their money. They're going to keep all of the money they have and not spend it. And this will be bad for the economy because in order for us to recover quickly, we need people to spend money to help to stimulate the economy. So if there is a lot of fear and uncertainty in the market, people are not going to be spending their money as much because they don't think things will be good in the future. They're going to want to keep all of the money they make or all of the money they receive and not spend it. So in order for there to be a good recovery and a quick recovery, we need to see people spending money, and there cannot be fear and uncertainty in the market. And right now there seems to be a lot of fear and uncertainty of how things will be moving forward. So anyways, that is all I got for you guys today. I hope you guys enjoyed today's video. Don't forget to get your 2 free stocks valued up to $1,400 when you sign up for the Webull investing app, 1 free stock when you sign up for Robinhood. Thank you so much for watching. Please be sure to like the video down below, leave a comment, and subscribe, and I'll see you guys next time.